Welcome to Chapter 12, and Chapter 12 is all about payroll. Now, most of you have jobs, and so you're familiar with the idea of receiving a paycheck. And so that's what I'm going to use over here to kind of get you to understand some of these things that are going on. But remember, in this class, we're looking at things from the owner or manager's side. So we're looking at how do you pay payroll? How do these things function for you as a business when you have to administer all these different things? And most of this is put on the backs of the businesses by the government. So a lot of the stuff that we're going to talk about here are actually government laws that are placed upon businesses that then have to understand these principles so that they can do paychecks in the legal way. Okay? So there are lots of different ways to get paid. The first one is a salary. So a salary is simply when someone works for a certain specific amount each month. Let's say they are getting $5,000 per month, and that is their salary. All right? So the advantage to this is that you always have the same amount of money going out, and so as a business owner, you just pay the same amount. That's the advantage. A lot of workers like it because they like the structure of getting that reliable amount of money, and they can then set and budget accordingly. The advantage for the business and the disadvantage for the worker is there's no real limitation on how much work you can assign to them. So usually you're going to find a lot of jobs that are salaried also have a high amount of work. So they might advertise, 40 to 50 to 60 hours of work will be a part of this job that's being placed out there. And you can always pile on more later because a salaried position simply means get the job done. Okay? There's no it's 5 o'clock and I'm going home. No. You get the job done. So that's the advantage of having salaried workers is you're getting a job completed because there's really no hourly, amount that is placed upon them. And that's much different than an hourly wage, which is the exact opposite. A person comes in at a certain time and they work to a certain time, and whether they're done or not really doesn't matter. If it's time to go home, they leave. Okay? So hourly wage workers are paid for the time they put in, not necessarily the result, and that's the drawback. So they're doing some function, and you might have expectations of how much work they should get done in that time, but if they don't get it done in that time, they just leave when it's time for them to go. Okay? Whereas the salaried person is expected to be there until the task is done. They have no limitations on time. It's just complete the task. Hourly workers are there based on time, regardless of whether the task is completed or not. Okay? There's other ways that you can pay people is a piece rate. So for the piece of work they do, you pay them a certain rate. This applies mostly to people like journalists. So for each article that they have published, then they are paid a certain rate for each piece of work that they turn into the newspaper or to the magazine or something like that. Okay? A lot of artists will be in the same category. So like graphic arts, how many paintings do you sell? How many online images do you sell to people that they're downloading or using? So someone's going to pay you a certain rate for that piece that you have and have put out there. Okay? Finally, there is something called commission, and commission is usually combined with either salary or hourly work, mostly hourly work. So you'll pay people like a base amount or $15 per hour plus commission. So if they work 8 or 10 hours, you're paying them for that. But then commission is based on how many sales you make usually. Okay? So like a car salesman might be paid an hourly wage just to be there and be available, but they're not really making that much money. It's only when they sell a car, then they get 5 or 10% commission on the sale they've made. All right? So this keeps people going enough that they're going to come in and do the basics as part of the business, and if they don't get as many customers, they're still getting something for their time, so it keeps them going as an employee. However, commission work really incentivizes the idea that you got to get out there, you got to make sales, you got to talk to people and complete the deal. Okay? Whereas if you had a car salesman on salary, they'd just be like, yeah, you want to buy a car? Yeah, who cares? Whatever. I'm getting paid regardless. Same thing with hourly. And so commissions are really there to motivate workers. So depending on how you want your business to run, you're going to pick different things for the employees you have. Okay? So keep those things in mind, and then probably take a class beyond this one, like a business class or entrepreneurship class, that will really discuss more in detail these type of things and other issues as well. Okay? What we're looking at for accounting, though, is payroll. So how are we going to pay someone on a salary or hourly, piece rate, or commission? They're going to earn some money. And what we're going to call that is gross pay. Gross means total. All right? So this is your total pay for the month, let's say. And what happens is, as a business owner, you've got all these government mandated things that you have to deal with, and then you actually distribute what's called net pay. This is what you actually pay to the employee. All right? So the employee receives $2,810. That's what they think they're getting. But you, the business owner, what you're paying is gross. You're paying the $5,000. But it goes to these different groups right here. Okay? So this is the disconnect that will often happen between management and employees, because the employee looks at this and they dream, and then they look at this and they realize that's reality, and they get angry. What you as the business owner have to explain is that that's where their money is going. These are all these taxes and other withdrawal systems that the government has mandated. And so that's actually the true amount. So as a business owner, you're going to pay the gross. The employee is going to get the net, and all these things we're going to talk about. All right. First thing you're looking at is a federal tax. So this will be on most things. You're going to find a federal tax will be on pretty much everyone's paycheck. And I put 5 to 10%. Depends on your tax bracket and how much you want to take out. That's a whole nother thing. When someone first applies for a job, they're going to fill out a W-4 form. A W-4 form specifies how much money they want taken out. They've got a rather complex formula, or you could just pick the amount. So the employee actually has to pick that, and then you as the employer have to then take that specific amount out, and you have to send it on to the federal government. All right? So it's up to you, the employer, to harvest the money for the government and then send it on to them. It's one of your duties of running a business according to the government. Okay? I picked 5 to 10%. That's pretty standard. 10% is probably a good amount. If you're in higher tax brackets, making like 150 or 200,000, you should probably take out 20%. The highest tax brackets are like, I think 36 or 39%, depending on what Congress and the President have decided recently. It'll be right around there. And so, yeah, you're looking at close to 40% if you're Bill Gates or someone like that. Okay? The W-4 form will also determine how much you pull out for state tax. Now, some states, there's like 4 or 5, don't have a state income tax, but most do. Oregon does. Washington doesn't. So in the Northwest, they've got 2 different states there. And this is your state tax. In Oregon, it actually at the lower levels is higher than the federal rate. So you're looking at 8 to 10% pretty much all the time. And that's how much you want to pull out. And so, yeah, you could have numbers like that where you're actually paying the state more than the federal government. Okay? But yeah, these numbers will be calculated on the W-4 form. The employee fills it out, and then you, the employer, have to then take that money out of their paychecks and send it on to the feds, and then you send it on to the state, okay? And you give a copy of that to your employee, and they see, oh, that's how much was coming out based on these governments. Third thing that we have for taxes is something called FICA or SSI, Social Security Insurance is what the I stands for. Social Security is something you receive when you turn 65, and it's a social program benefiting seniors, and they receive money for getting old, I guess. And usually that is currently 6.25%. So that's going to come out of your paycheck right around that amount, and that's just fixed. You have to take that out if someone makes an income, and that goes to the federal government. The fourth thing you want to calculate is Medicare. This is paying for prescription and treatments and doctor's visits for old people. If you're 65 or older, 1.75 goes into a program called Medicare and Medicaid, so you might see that on your pay stubs. And that also gets mailed off to a separate program at the federal level. So you have to send three things: federal tax, Social Security, and Medicare off to the federal government in their different forms. And then you have to mail off something for state taxes if you're an employer. So this is part of running a business if you have employees. Okay? Those are the usual taxes you will see. Most states will require some sort of workman's compensation. It's like basically insurance for the entire workforce of the entire state. And so that's simply a flat fee. It's required by the state, and I'm just putting $15 out there. It's not usually big, but it's there. And that's usually just set by the state as everyone pays this much every month. All right? Sometimes you want to join a union so that you get the benefits there. Sometimes you're forced to join a union. That is interesting. But those are usually flat fees as well, where the union negotiates with the management, and that's how much has to be taken out. So that's mailed off to the union every time you hire someone, and every month they get paid. All right? And then finally, you might have choices that people will make on their paycheck. So this down here is a choice. Some people will pay life insurance, hospital insurance, cancer insurance. All those kind of things might come out of someone's paycheck by their choice. In this case, this is a retirement plan. The most common retirement plan for private businesses is called a 401k. So in the law books, Congress said in volume 401, paragraph K, private businesses can have retirement accounts. That's where that comes from, okay? Mine as a teacher is a 403B, because that says public employees can have retirement accounts. It was a different law. So I have a 403B, 401k, there's a SEP, a SARSEP, a Roth IRA. There's all kinds of different retirement accounts in the laws. And you as an employer will have to take money out of people's paychecks and put it into one of these accounts if your employee selects it, and you have that option, okay? So this one has an option for a 401k, a private retirement account, and it goes into that person's retirement account, but they're going to have $1,000 taken out of their paycheck, and it's going to be mailed off to that retirement account. And the reason people do this is because in the law, this money comes out before taxes. So you save the $1,000, and it looks like to the government you didn't make $5,000, you only made $4,000. It comes out before taxes, so it shelters the money, or it hides it from taxes, at least temporarily. Once you take the money out, once you're 59 and a half years old, I know that's the way it was written, 59 and a half. Then you can take this out without penalty, and that's your retirement account. All right, and then you got to pay taxes on it then. So it defers the taxes to a later date. So you don't pay taxes now, you pay them when you're retired in the future. Okay? So a lot of businesses will offer this for those reasons, and a lot of people will take it for those reasons. So these are some of the most common things you're going to see on a paycheck, and you as an employer have to collect that money out of the employee's paycheck and then distribute it to all the different places. So this is what is known as bureaucratic red tape, and why some people don't hire employees. Like for my business, I didn't really want to hire employees because that would be a whole lot more work than I actually have right now. Okay? So what I do is I just pay people piece rate. I just I ask the plumber to come fix something at my rental, and I pay them for that piece of work they do, but they're not my employee. The electrician comes and they do something. They're not my employee, so I don't worry about this. I just write them a check and say, there's $200 or $500 or whatever the work was. It's piece rate work. Okay? So hopefully that'll answer some questions, but maybe give you some more to ask in class about what you need to pay as an employer and how paychecks work.